the first one for the month. Good morning, good evening, wherever in the world you're watching from. It's Business Morning live on Channels Television. I'm Ladi Williams, and it's great to have you join us. Happy new month. First off, let's kick off your morning now with markets. Now, we see oil prices rose, pairing losses from the previous session. Brent crude for January delivery rose about 73 cents to $93.54 a barrel. The December contract expired on Monday at $94.83 a barrel, down 1%, while U.S. West Texas Intermediate crude rose about 58 cents to $87.11 a barrel after falling 1.6% in previous session. OPEC raises forecast for world oil demand in the medium and long term yesterday, saying that $12.1 trillion of investment is needed to meet the demand despite the transition to renewable energy sources. To other markets now, Chicago wheat futures jumped 6% and corn rose more than 2% yesterday. The most active wheat contracts on the Chicago Board of Trade, WV1, was up 6.1% at $8.79 for half a bushel, having touched about $8.93 for its highest since October 14th. European markets also rose with benchmark December BL2Z2 milling wheat futures on Paris-based Euronext up 3.6% at 349 euros a ton after touching a two-week high of 352 euros a ton. And back here, the amount of revenue generated from Nigeria's rail transportation dropped to 598.73 million naira in the second quarter this year, and that's according to latest reports by the National Bureau of Statistics. The amount represents a significant drop when compared to 2.07 billion naira recorded in the first quarter. At the same time, the number of passengers fell from previous 953,000 to 422,393, and this is largely due to the
negative implications for the global economy. One, that means that the food and energy prices that we are currently seeing, the food and energy crisis that we are currently experiencing, I beg your pardon, would linger for longer. It also means that for many, it also brings to fore, some journalists called it the Hunger Games, right? It also brings to fore that the issue of food insecurity that is ravaging many low and middle income countries. It means that, the commodity prices are going to increase quite sharply, but also given weaker currencies in many of these low and middle income countries, food is going to be expensive. It's going to be in lower supply, and then it's going to push millions and millions of people further into poverty and into starvation. Last week or 2 weeks ago, the World Bank released a report citing that, this Ukraine and Russia war is increasing food insecurity. And now with Russia pulling out of this, I think it's just going to worsen the situation.
Yeah, and obviously I know the next price movement, we see depends on, Russia's next move. What do you see coming?
I think it's a bit too early to say, Ladi. I think we need to just keep watching the space, at least this week. I know I expect we hear some news from Russia coming this week. At the moment, we are seeing some blame game. Russia is blaming Ukraine. Ukraine is blaming Russia. We're seeing all of that. And the United States also blaming Russia. So we are seeing a lot of blame game at the moment. But I think because the implications are quite huge for the global economy, particularly for low and middle income countries. I think, particularly the issue of food insecurity, right? Already it is bad. Like a lot of countries are struggling with starvation. Food is expensive. There's a shortage of supply of food, particularly some of these key commodities. In addition to that, due to weaker currencies, it is even more expensive. So I expect we hear some news about Russia's position in the coming weeks. Already, yesterday, I know that Ukraine still released some cargoes of food, some of these grains yesterday. We don't know what Russia is going to do about that at the moment. Hopefully, they do not do something drastic that will further push prices upwards.
Right, and what do you see coming for, food inflation? At this point, we know that's already elevated right now.
I didn't get that question. Can you come again, please?
For food inflation.
Oh, food inflation. I think if what we are seeing persists, if the prices of these commodities, wheat, corn, barley, keeps trending upwards following Russia's suspension of this deal, I think food inflation is going to continue to trend upwards. I mean, if you look at Nigeria, for example, Nigeria, look at the floods already. The floods are already pushing domestic commodity prices upwards. We have a weaker currency, which is also worsening imported inflation. Now with this, and we know Nigeria imports a huge portion of its wheat requirement. So if you look at, your flour, your other commodities that have wheat as an input are likely to trend upwards if, this persists.
Right. On your slide again, there's see that steel companies' profits are falling, at this time. What's driving that?
I think it's just a sharp drop in the prices of steel, right? Quarter on quarter, at least for Q3 2022, the price of steel dropped around 60%, and that is that's really affected the revenues for many of these steel companies. I mean, the Tata India, which is like the largest steel company in India, they recorded, an 87% decline in their profits in the third quarter of this year. And many other steel companies globally also recorded sharp declines in their profits in the third quarter of this year. And that's just mainly due to the sharp decline in the prices of steel globally. Also, that's driven partly because of the slowdown in global economy. We are not seeing a lot of infrastructure projects at the moment due to the slowdown in the global economy, as well as the higher interest rate environment. And all of these factors are driving the prices of steel downwards, and is also hurting the profits of many steel companies globally.
All right, let's look at the Naira now. The market we don't like to talk about. We're seeing it there plunge about 805 Naira to the dollar. And we see the external reserves also down at $37.45 billion. Is it the redesign proposal? Is that what's driving it?
I mean, at this point, like, there are many factors. We know about the big legacy factors that are driving the Naira. Like, the next month is Christmas. There's a lot of demand coming for Christmas, coming from manufacturers to, get their stock up to date in anticipation of Christmas. We've got the election. Also, the redesign is also having some big effects on the Naira. But I would really not love to push too much on that now. But I'd like to tell you about some of the good news of the weaker Naira, at least for the Nigerian economy. And that would be what's the word now? Remittances, right? And with the weaker Naira, there's a lot of evidence in the literature to suggest that, when a currency is weaker, particularly in the receiving country, we see more and more remittances. So despite as the Naira is weakening and it's bad news for many people, there's also some light at the end of the tunnel. There's some silver lining, and that silver lining is remittances. I mean, last year, the World Bank estimated that remittances to Nigeria was around, I think, $22 billion US. So that is some huge inflows. And this year also, given the weaker Naira, I think we expect more and more an increase in remittances to Nigeria. In addition to that, we also have more and more migrants from Nigeria. We had over the, I think in Q3, we had around, at least the UK, around 65,000 new migrants moving to the UK. And these people are likely to continue to send remittances, back home. So I think that is one positive effect of this weaker Naira, is that the inflow of remittances to Nigeria would increase significantly.
And I see, looking at the domestic commodities market, there, I see most prices, trending upward.
Yes, indeed, the two big factors affecting domestic commodities prices at the moment. One is the flooding, which is kind of creating a shortage of some of these commodities and pushing prices upwards. In addition to that, the weaker currency is also worsening imported inflation. I mean, if you look at the prices of some of these big commodities, look at the price of Gari is up 77% to 23,000 Naira. If you look at the prices of onion, a 50 kg basket of onion is up 44% to 46,000 Naira. If you look at the bag of rice, for people who, for Christmas, I think that's going to be quite interesting how that works out. A bag of rice has increased 40%, is now 45,000 naira, and many other commodities also are trending upwards. We just have a few commodities who are flat, like cement, for instance. 50 kg bag of cement is flat at 4,200 naira, as well as semovita. A 10 kg bag of semovita is also flat at 6,300. But most other commodities are trending upwards, and mainly due to the effects of the flood, as well as imported inflation from the weaker currency.
All right. Thank you so much, Dr. Adesola Sumoni, analyst, financial derivatives company. It was great having you. Thank you.
Thank you for having me on the show.
All right. We'll take a moment now. Welcome back now to our next conversation. Last week, Moody's announced its decision to downgrade 3 non-financial corporates that are domiciled in or have substantial exposure to Nigeria, and also placed on review for downgrade the long-term deposit ratings, as well as the long-term issuer and senior unsecured debt ratings, where applicable, of 9 Nigerian banks. Let's get a sense of what these downgrades mean for the Nigerian economy now. We have Yomi Ajayi, banking and finance analyst with Stairs. Join us. Great to have you on the program. Hello, Yomi, can you hear me?
Good morning, everyone.
Good morning. So, Yomi, break it down for us. What do these downgrades signify? Hello, Yomi, I don't know if you can hear me.
Sorry, if you're speaking, I think you have to unmute because I can't hear anything.
Can you hear me now? Hello, Yomi, can you hear me now? Okay. Okay, I guess Yomi cannot hear me. I'm going to try and get Yomi back. We're talking about the recent Moody's downgrades, and we'll try to get a sense of what these means, for the Nigerian economy. We're going to get Yomi Ajayi back, banking and finance analyst with Stairs. Yomi, can you hear me now? Hello, Yomi, can you hear me? All right, seems Yomi cannot hear me. We'll try and get Yomi back, having some technical issues there. We'll take a quick break now. When we come back, we'll continue the conversation. Do stay with us. Welcome back. Let's try and get Yomi Ajayi now. Hello, Yomi, can you hear me?
Yes, I can hear you. Sorry,
fantastic. So I would say, Yomi, break it down for us. What do these downgrades signal?
Okay, so the downgrades coming from Moody's, they're very negative. What they signal is, and what Moody's also said was that the companies in themselves are fine. So we have Seplat, Dangote, and IHS holdings that were downgraded, non-financial institutions that were downgraded. And Moody's themselves said that the companies themselves were fine, but then due to their exposures to the Nigerian economy, right, that was the reason for the downgrades. So you look at the specific companies, Seplat, for instance, although they receive their revenues as an upstream oil and gas company, although they receive their revenues in dollars, they still have to repatriate it into Nigeria, which goes through the CBN within 90 days, and then they can take it out to their offshore accounts. And Moody's was citing that there's a risk that money could be trapped in Nigeria and they won't be able to get that money back. So far, that has not happened, but there's just a risk due to the FX shortage that we're seeing. And we've seen foreign airlines complain about not being able to repatriate their funds. So this is also something that could happen to Seplat. For Dangote Cement, they face increased risk or credit risk from their operations in terms of, first of all, they have a lot of short-term debts that they have to refinance very soon. So due to the increased interest rate environment, that could become very expensive for them. About 60% of their debts are short-term debt, and that could easily become a problem for them. Also, in terms of their exports, in terms of the revenues that they get from other countries, right? Because as we know, it's not just Nigeria that's facing this FX crisis, right? We have countries like Ghana also, they're facing these countries. These are countries that Dangote exports to, and they also trade in local currency before they have to convert their dollars to pay to Dangote. So there's also that risk. For IHS has a lot of clients, many of them, the MNOs, which are the big telco companies we know. They are invoiced in Naira, although IHS has some safety measures, right? In terms of their invoices are priced against inflation, and they account for exchange rate devaluation, right? But then the companies, the MNOs themselves, are also at risk of the FX shortage, right? And in terms of even the capex spend that IHS spend on their towers to maintain their towers, there's also that risk. So based off of all of that, and not necessarily as a fault of the company itself or the companies themselves, right? That was the reason for the downgrade.
Quite interesting. But how bad, are these downgrades?
So, like I said, the first, or which is the most significant problem for them, is that these downgrades would affect their ability to raise capital. These companies are hugely capital intensive, right? So they need capital. They're always at the capital market trying to raise money. So this will become increasingly difficult for them, because lenders would ask for more returns in terms of interest rates on the debt that they're trying to raise. Secondly, if you look at their performance on the equities markets, the IHS is listed on the New York Stock Exchange, Seplat is dually listed on the NGX and the London Stock Exchange, and then we have Dangote and Nigerian Stock Exchange. Currently, the equities market has been hit by increased interest rates, right? That we've seen the equities market, retract in terms of its performance this year. So that's going to be negative for them, because investors who are looking to buy into these companies, these blue chip companies, as you might call them, maybe IHS, but investors looking to invest into these companies do so because they are expecting future cash flows, right? That would trickle down to them either in terms of dividend payments or higher stock prices. So we'll see this negatively affect their stock prices also. So it's a double whammy for these companies.
Yeah, but let's take it down, to the Nigerian economy. What impacts can we expect?
Because we should not forget that it wasn't just the DFIs, it wasn't just the NFIs, the non-financial institutions that were downgraded. We also had 9 Nigerian banks that were also downgraded. We also, a week before, we also had Nigeria's credit rating was also downgraded from B3 to B2, meaning even for the Nigerian economy, even for the Nigerian government, it's going to become increasingly difficult for them to borrow. As we know, they just announced our largest budget ever, which is a 20 trillion budget, which is expected to be, has about 11 trillion deficits, right? And it's going to be funded by borrowings. So it's going to be increasingly difficult for them to visit the international market, if at all they do, to raise debt. So and again, what that means is that you have important spendings, or like infrastructure capex, right? Those are the things that are going to suffer, because they have to continue with their subsidy scheme, and they have to continue with the recurrent expenditures like debt servicing and all of that. So what this means for us is less money to spend on development, on growth and development, and that would be negative for us. Also, it means that we're likely going to see less investors coming into the Nigerian market, because if a downgrade signals, right, that the basis of the downgrade is because there are no dollars and there's a dollar ceiling in the Nigerian economy. And people don't want to get trapped, because if I'm coming in with my money, the point is that I'm able to make returns and repatriate back to my home country. But if I can't do that, there's no point of me bringing my money in. So less capital flows and less growth.
And we know Warren Buffett's mantra there. It says buy when the market is fearful and sell, when the market is greedy. Do you think there'll be some investors out there that even though there's fear, lending, down here, do you think there's some that will still take that plunge and say, you know what, I might make some more profit? What are the opportunities there?
Well, as they say, yes, the market is driven by fear and greed. But then, you need to look at the prospect of when the stock prices are going to go back up, the outlook of the equities market. And right now, what it seems is like prices might still go down even further because even monetary authorities around the world are still signaling further rate hikes, although they might have been priced in currently. But then if there are any other shocks to the supply chain, or maybe energy prices or anything, and inflation continues to go up, there might still be more interest rate hikes. In fact, I think it was last month during the IMF meeting when they said there's a 99.9% chance of a global recession next year. Sorry. So that means that the outlook for the equities markets is not so positive right now. It's very gloom at the moment. So if anybody that is coming in, they'll be very cautious, especially for the domestic investors. They'll be very cautious and stagger their purchases right now. But then for the international guys, the foreign portfolio investors, you might not see them coming in because, like I said before, the main reason why they're coming in is because they should be able to get their dollars out. And if there's no assurance of them being able to get their dollars out, the dividend yields that we're seeing on like a GT, for instance, that's giving about 18% might not be so attractive to them, because what's the point if I make that money and I'm still trapped in your country?
All right, but do you see future downgrades on the horizon?
Oh yeah, definitely. So Moody's actually placed the 9 Nigerian banks, the 3 non-financial institutions, and even the country's credit rating itself on review for further downgrades. That if there are any more shocks to the economy, right, there'll still be further downgrades. In fact, so S&P, this is also in line with S&P's ratings. So S&P and Moody's have downgraded us. Currently, it's just Fitch that hasn't downgraded us. But I think they should be releasing their ratings in November, and we'll probably see them go in line with the other 2 rating agencies. So yes, there will be further downgrades for us.
All right, thank you so much. That was Yomi Ajayi, banking and finance analyst at Stairs. Thank you for giving us your perspective.
Thank you for having me.
Thank you. So we've been talking the Moody's downgrades now. Well, we're going to head to the markets. We have Aniete coming in now to give us the details on what's happening. Aniete, great to have you.
Morning,
yeah, so it started yesterday. That was, we're still in October,
yes.
But it was, the market started, in the red, and now we're in November. What are we seeing?
Well, the final day of October, of course, it's like we said, it's in the red. It's still red. People are still taking profit, and of course the market's year-to-date performance, it has lowered all the way from that high that we'd seen. We'd seen a high of about 43%, but we're now down at about 2.63%. So it just shows you that investors, the macroeconomic environment is still not favorable to some people. So profit taking is affecting the market, the equities market in particular.
But I hope year-to-date it still stays in the green somehow.
Yeah, it's still in the green.
It's holding.
Just hold your breath on that, because anything can happen.
Right.
It's reduced the positivity. The positivity that you had has reduced already to just about less than 3%.
Wow, crazy.
So now, with that being said, let's go straight to the markets. At the close of Monday's trading session, which happens to also be the last trading day of October, we're in a new month now. This is how the market turned out: 0.17%. Translating to about 40 billion loss in value. And of course, as at Friday, we had already fallen from the 43,000 level. As at September, I mentioned yesterday that we were at 49,000, but that level has been reduced all the way from 49,000 to 43,839.08 points, while the equities cap, which was also as at September, it was 26 trillion, but there you have it, 23.877 trillion, and that is no thanks to profit-taking, the impact of profit-taking on high-value stocks on the market. Of course, investors have been really putting their money where their mouth is, so it's not surprising that that would happen. Now, in terms of sectoral performance, this is how it turned out. The lone gainer there was the insurance sector. All the rest were down. The consumer goods, in particular, it fell by 0.3%, no thanks to losses from International Brewers Limited, which also will be having its fact behind the figure today. Now, let's take a look at the top trades there. The volume of transactions, it was up. The volume of transactions was up by more than 31%. Value was down. The deals was also down. But now, to give us more details, if we have it, let's talk to Grillo Abdulatif, who's an investment research at Maritime Securities. Okay, so we don't have him for now. So now for that market, still dwelling on the market, the sectoral performance, it was mixed. And of course, we're having kind of like a flurry of activities for that market, a flurry of third quarter and 9-month earnings, which has been positive, but then the market has not been reacting too positive to those earnings results. Of course, we know that so many factors affect the market. At some point, some people are migrating to the fixed income market and talking about the fixed income market, which is still tied to this equities market. The activities for the bond market, it was still bearish, ending the last trading day of October bearish. Average yield there expanded by 11 basis points to 14.4%. Across the benchmark curve, the average yield expanded at the short and in the mid segments, following sell-off of the March 2024 and the April 2029 bonds, respectively. Conversely, the average yield contracted at the long end. It contracted by 3 basis points as investors demanded the March 2035 bond. Now, still with the fixed income market, when you move over to the Treasury bills market, it traded with mixed sentiments, albeit with a bullish tilt, as average yield paired by 1 basis point to 11%. Across that curve, the average yield contracted at the short, mid, and long segments due to mild interest on the 24-day to maturity, the 192-day to maturity, and the 318-day to maturity bills, respectively. Then for the open market operations, what you call the OMO market, average yield there it declined by 1 basis point to 10.2%. At the OMO segment. Now, what are we to expect at the fixed income market this week? We expect the yields to maintain the same trajectory following a thin liquidity, which is expected in the system, and that's for the Treasury bills market. For the bonds market, traders are expecting they maintain an uptick in the yields for the bonds market. That's due to the federal government's borrowing plan for this year and expected fiscal deficit, which is pointing to an increased supply. Then at the money market, don't forget, we've been talking about the Naira's value, which has been dropping of recent. So we're expecting overnight rate to trend upwards. At the same time, the 20 billion Naira is expected from OMO maturities this week. Of course, they're saying that they don't expect it to be sufficient to saturate the system and keep the system afloat for the market. So, Ladi, that's it for the market.
I think your guest is actually ready now. Let's see if he can, talk to us. You can try him now.
Okay, Falabi, if you can hear us, can you join us to tell us more about the equities markets?
Hi, good morning, and thank you very much for having me. Okay. So, like you said, the equities market lost 0.16% yesterday, and I think the major driver of that loss was international breweries, which lost more than 9%. And we also saw that the market remained quite bearish yesterday. We saw about 8 stocks close up, while about 19 stocks lost. And this is not so very much surprising because we didn't really expect investors to react so much to the earnings releases, which we have seen across sectors. We have seen very positive performance across sectors. Banking stocks, we had double-digit revenue and earnings growth. The agricultural sector, double-digit revenue and earnings growth. Telecom sectors, good performance. For consumer goods, maybe not so well. the inflationary pressures caused their bottom line to shrink a little bit. But then again, looking at the equity market, this positive performance we are seeing, this positive performance and this performance is not trickling so much into the equities market. And for most of the buying interest, we actually saw a bit of buying interest yesterday, and that was majorly on banking stocks. I don't think any one of them gained up to 5%. And that's quite understandable because in the long run, we don't expect these companies to actually grow more than the environment in which they operate. And if you look at the heightened macroeconomic risk in the environment still persists. So that's part of what is keeping investors away from the equities market. There's also the build up onto the 2023 general elections with heightened political risk and high fixed income yields. Also, not a lot of companies declared interim dividends for this period. I think for now we have just Seplat and Airtel Africa have declared interim dividends for this period. So there's not so much reason for investors to actually buy into the market despite positive results and low prices that we are seeing presently. And that's what we continue to see. There's also the MPC meeting coming up later in this month, which we could see the MPC continue to take a contractionary approach, and that's also deterring investors from buying into the equities markets majorly.
Okay, now, Grillo, before I let you go, I know that between last week and today, there's the start of November, some earnings are still pouring into the market. Can you give us a list of some of the latest earnings, and then how's the market reacting at the moment?
Okay, like I mentioned, we have seen earnings across sectors. For banking stocks, like I mentioned, quite positive performance because of good interest income. You agree with me that we have seen the yield environments become much more positive than we had a while ago. So that's really impacting on the performance of banks. We have seen double digits growth in earnings, in both revenue and earnings for banks, but that's not translated so much into buying interest in the secondary market. Just a couple of them have actually seen some buying interests, the likes of UBA Access and the likes of UBA Access. I saw some buying interest, I think yesterday and even on Friday when their earnings came out. And if you look across other sectors, say telecoms, for example, MTN, they had very positive performance, double-digit revenue and earnings growth, and we still saw the stock lost a little bit yesterday. Looking at the agri sector, very positive performance from both Okomo and Presco, double-digit revenue and earnings growth, and they have remained flat since. So investors are not really buying into this stock based on the positive earnings we are seeing, and that's because the macroeconomic environment still remains very much uncertain. We are seeing a decline in PMI, which is the likely indicator of a decline in GDP in the third quarter. We are seeing the pressure on the exchange rate continue to persist. We are the external reserve has been on a free fall, and a lot of other inflation is speaking at about 20.77%. A lot of other macro fundamentals just point to a not very good time at this point. So I think that's what most investors are concerned about, and the alternative for them, which is fixed income, is doing quite well at this point.
Okay, thank you, Afolabi. I think I'll just keep my focus on some stocks which I keep close to my heart at the moment. Thank you for that analysis. That was Afolabi, Grillo Afolabi, research analyst at Maritime Securities Limited.
Right. So fingers crossed for November, in these markets.
Yeah, Ladi, I'll tell you, my crystal ball says the market is still going to go down. So, but of course, when it goes down, it's good for some people, and then it's not good for some other people.
All right.
Yeah, so for the entry, yes, it's a good time to enter.
Okay, thank you so much, Anita. Well, we'll take a break now. When we come back, we head on to London. That's in a moment. Do stay with us. Welcome back. Let's head on to the UK now. We have Juliana standing by right there. Great to have you, Juliana, and happy new month. Well, it's, tax rises seem like they're likely to come as soon as government the UK government there seems to be facing some kind of issue, when it comes to that deep hole, trying to fill it up. How's it looking over there?
Good morning, Laddie. Well, we have heard reports this morning that, yes, in the upcoming autumn statement, which was supposed to be a small fiscal statement delivered on October the 31st, yesterday, Halloween of all days, but that, of course, has been pushed back to the 17th of November. And yesterday was the first day that the Prime Minister, Rishi Sunak, sat down with his Chancellor, Jeremy Hunt, and started outlining how they are going to try and fill this £50 billion black hole that was, of course, unveiled during the market turmoil caused by Liz Truss's unfunded mini budget. And we are hearing, yes, that there will be tax cuts or tax rises for everybody, but the headlines here in the UK say it's those with the greatest shoulders that will bear the greatest responsibilities. Now, this is obviously not going to go down well with the Tory faithful, because they do believe that they shouldn't be paying more taxes. I do have a brief outline of what we could potentially expect in the next couple of weeks. Now, we've got the health and social care levy. This was a controversial topic because earlier in the year, Rishi Sunak, when he was then Chancellor, decided to raise NI by 1.25%. That was reversed in the mini-budget, then put back in place by Jeremy Hunt. Are we going to see more national insurance income threshold taxes? There's also that 1p income tax rate rise. Are we going to expect that to be reversed, and we could be paying more on our income tax? Now, another thing that's been put out by the media today is the potential that public sector pay increases could be frozen at 2%, and this is going to be a serious issue because we know that we are heading into a winter of discontent. So many employees across many sectors are not happy with the fact that we've got inflation at a 10-year high of 10.1%, and wages are not growing with inflation. So it is really, really difficult, and it is going to be a huge challenge for Rishi Sunak to try and get over. There are also challenges at the moment with the Home Office and the Home Secretary, Suella Braverman. So many people are asking her to resign. There are issues at the border. We know that so much more public funding is going to have to go there, but people need support. There has already been targeted support. The Prime Minister says he is going to try and help everybody, but the fact that there's a £50 billion black hole that needs to be filled at a time when we're heading into recession is going to be a lot of headache for the Prime Minister. But there's still a couple of weeks, so we'll have to wait and see if there's any more leaks to the media before then.
Wait and see. Wait and see. That's what we're going to keep doing. Thank you so much, Juliana. We'll talk again at 1:30. Thank you so much. All right, that was Juliana. They're giving us the details from the UK. Now, let's move on to other markets. Now, we see Bitcoin started a downside correction there below the 20,500 level against the US dollar. If we look at the sentiment in the crypto market now, we see the sentiment there. We see it's still fear in the market. If we flip over to our fear grid index there, we'll see that the market is still fearful, but better than extreme fear than what we've had most of this last month into, but it's a fresh new month now. We might see maybe the market will pull out from this fear level and maybe get into some greed, but I've not seen greed in this market for the longest time. And also we see the Bitcoin white paper there, Satoshi's famous white paper, turning 14. It's the 14th anniversary. Let's talk to Amari Sachet now to tell us what this means. Hello, Amari.
Hey, hello.
Great to have you, Amari. So it's the 14th-year anniversary of Satoshi's famous white paper. How significant is this?
I mean, it's a landmark time in the history of Bitcoin, I guess. When it came out, you know, a lot of people did not take that paper very seriously. And now we are 14 years later, where it's driving a major, you know, economic powerhouse. So I would invite, this is a very easy to read paper. This is not one of those very difficult scientific paper that most people won't understand. Actually, most people will understand the Bitcoin white paper. So I would invite people to maybe have a read at it and see what's actually in there.
Quite interesting, and quite an interesting read. Obviously, talking about the Bitcoin white paper by Satoshi. But looking at the market right now, where it is, has the market, the industry, you know, stuck to what that white paper actually sought out to get in the market?
Not really. Like the white paper is really about digital cash to begin with. And it seems that the market has become much more speculative over the past, many years now, maybe 8 or 7 years. So we've been departed away from that paper, but, to some extent it's fine. But in our project eCash, we try to stay true to that original intent, at least.
Quite interesting. But Amari, what do you see, the crypto industry say in the next 14 years, post, this white paper? Do you see the industry still sticking, to the plans, that Satoshi had, for payments?
I think we're probably gonna come back to that plan more. At least that's the hypothesis I'm operating on, because we see all those CDBC projects and more and more control around payment processors and stuff like that. So I think the value of being able to do your own payment and use cryptocurrency as medium of exchange is going to be on the uprise in the next 14 years if this is the time frame we are looking at.
All right. Well, 14 years, quite a short time. Some will see it as long, but quite short, for such an amazing white paper that's changed the way, people look at payments these days. Thank you so much, Amari Sachet, creator of eCash. It was great having you.
Thank you for having me.
All right, so that's the market today. Don't forget to join us at 1:30 for Business Incorporated for more updates and developments in the world of business. Remember, you can watch this again on all our other shows on our YouTube page. Just search for Channel Television on YouTube and flip over to our videos. You can watch all our videos. Again, thank you so much for watching. Happy New Month. I'm Ladi Williams. Bye for now.